I'm Scarlet. This is Bloomberg ETF IQ, where we focus on the access, risks, and rewards offered by exchange-traded funds. Nothing to look at here. Stocks may be in sell-off mode, but trading in ETFs goes off without a hitch. Silicon Valley meets investing. We drill down into an ETF driven by algos that time the market. And swanning around, the ETF that aims to protect investors from unpredictable events. It's doing its job during the black swan sighting of the coronavirus. Now, whether you embrace or reject ETFs, there's no getting around their influence, and Eric Balchunas is Bloomberg's own big cheese on reading flows to extract bigger themes, and the big cheese gets us started now.
Thank you, Scarlet. Okay. So, look, it was obviously a crazy couple days, and ETF flows show that the most outflows in a week in over a year, right? So that's that number, 11 billion there. But first, let's look at the inflows. Some stuff did take in money. Really, two areas, Vanguard and safe havens, right? You see the V's in here. Vanguard investors still plow money. You cannot shake them, so that's expected. And then the safe havens also expected. GLD, there's treasuries, you've got low vol and treasuries and staples. So the places you expect people to go when they're scared. Let's look at the outflows. Now, this is where things get kind of interesting. And really, it was, I'd call it a bloodbath, especially in the trading crowd ETFs. Look at SPY, 15 billion. That's the most since Volmageddon, right? HYG, 3 billion out. That's its most ever in a week. EEM, right, all the usual suspects, which brings me to the chart I love to show, which is traders versus allocators. And they were in tune for many months, since Halloween really, but they've now divided. The traders are spooked, right? Obviously, coronavirus has them running for the hills, but look at the allocators. They're holding strong. So that's a good sign. So Scarlet, as long as that blue bar there is secure, Mom and Pop is still buying. That's a good sign, but it's been a rough couple days.
Well, they've been trained during the last couple of years to buy the dip, and that's what's been happening. Let's bring in Dan Russo. He's Chief Market Strategist at Chaikin Analytics. And we also want to welcome Vildana Heinrich, a cross-asset reporter for Bloomberg News. Dan, you heard Eric's take. Do you see a similar divide between traders and allocators as well? I wonder what you're hearing from clients and how you're advising them.
Yeah, that's it's an interesting point. I think the trading crowd really over the past few days, you've seen this kind of waterfall decline in the market. And really, I think the key level for the S&P 500 was 3250. When 3250 was taken out, that was a key technical level that led to more selling. And now we're kind of looking for a floor or an area where buyers might step in. We're getting a little bit of a bid to the market today. You kind of have this support area between 3,000 and 3,100 for the S&P 500, which interestingly holds the area where we broke out in October at about 3050. That lines up with the 200-day moving average and is also roughly a 10% correction from the recent highs. So I think traders who have to manage risk in the short term, yeah, that's what we're seeing. And allocators are using the opportunity to put capital to work in some of the leading funds.
All right, so Dan talks about technicals, and certainly that's a catalyst for people to do something, Vildana. But if allocators are staying put, and we saw that with those V tickers, the Vanguard funds, what's the narrative for those who are selling?
Well, we've often heard this argument that this bull market has been the most hated bull market of all times. There's always been this group of skeptics and investors who have doubted that stocks can continue to go up, and they've instead argued that really it's been the Federal Reserve that's been propping up asset prices. And so when we started to see stocks sell off so violently at the beginning of this week, we saw a lot of those investors rushing for the exits. At the same time, arguments that the Federal Reserve once again needs to step in and cut rates. We're hearing a lot more of those arguments, and the situation is just so uncertain that a lot of investors are coming out and saying, I'm not sure how effective a cut might even be considering the uncertainties around the virus.
So Dan, I asked you to bring some ETF picks, ETFs you're recommending your clients. Now, we talked when the carnage was happening, and you said, look, we still like growth. There's growth, communications, tech, even semis. A little gold there, but let's talk about those four. You still like growth even after what we've seen? Are you holding strong with those?
I do still like growth because I think what's happening is investors are beginning to discount a slowing global growth environment. And we're of the view that in that type of environment, you'll pay a premium for what actually is growing. So at Chaikin Analytics, we've been highlighting the Vanguard S&P 500 Growth ETF, which in our ETF model has a very bullish rating. It has more bullish stocks as holdings than bearish stocks, and it's been outperforming the market. And if you look at it, it's really been outperforming value. Again, speaking to the fact that in a world where growth could be scarce, you're willing to pay a premium for growth. I think the natural extension of that is technology, right? So if you look at something like XLK, also a very bullish rating. Again, part of that growth over value dynamic and just looking for growth in a potentially slowing growth world. And from there, I think you made a great point about it being a hated bull market, because one of the other themes that you're seeing is kind of this barbell approach, right? Where investors are bidding up growth, they're bidding up areas like technology, but at the same time, they're going into the safe havens, like you mentioned. So if you look at something like the utilities ETF, right. XLU, right, is outperforming the market. It has a very bullish rating in our model, and it's very similar to what we saw really for the first 3 quarters of 2019.
So it's a little bit of a barbell approach there. Vildan, I want to pick up on what Dan was saying and talk about tech here, because yes, it's obviously a growth sector, but at the same time, it can also be seen or interpreted as a safe haven, because that's certainly what we got a taste of earlier this week as well.
That's what I'm hearing a lot from investors I speak with. So if we think about XLK, for example, its top holdings are Microsoft and Apple, some of these really high-flying names that have been rallying for months and months. And so one investor I spoke with said investors are looking at these names and they're thinking of them sort of as a defensive or a safe haven play because of their really strong balance sheets.
This is interesting to me because XLK has almost doubled the S&P over the past 12 months. Given that level of outperformance, you still buy it. I mean, just talk me, it goes against intuition that you would still want to own that even after that run. You think it has legs? Well,
I'm a believer in the momentum methodology. Right, and I think really you have to take a step back and say, what kind of investor am I and what's my time frame, right? I think if you've been overweight technology, it makes sense to continue to be overweight technology. At one point last week, I was looking at the relative relationship between XLK and the S&P 500, and it was 3 standard deviations above its 200-day moving average. So do I necessarily want to chase it there? No, but if I'm thinking out over the next 6 to 9 months, if I'm looking at the rating within our model, if I'm looking at the ratings that we have on the underlying holdings, then yeah, I'm happy to be overweight technology.
Very quickly here, you also had a gold ETF on your list as well. How does gold fit in here? Because it started catching a bit at the end of last year, and it went up even as stocks went up. So it's not exactly a perfect hedge anymore.
It's not a perfect hedge, but I think it speaks to that slowing growth dynamic that we were talking about. I think there's a level of uncertainty around the global economy. So people still want exposure to the equity market via growth and also some of the defensive areas. But at the same time, they recognize that there are these risks out there. So they've been flooding into funds like GLD for that exposure.
Got it. Our thanks to Dan Russo of Chaikin Analytics. And we also want to thank Bloomberg's Vildana Heinrich. Now, coming up, Brown Brothers Harriman's Ryan Sullivan, Senior Vice President of Global ETF Services, will give us the details from the latest ETF survey by the firm. And one fund that caught our attention this week, State Street's $11 billion Industrial Select Sector Spider Fund, ticker XLI. During all of this week's volatility, the fund saw a record outflow of about $850 million. By the way, you can catch that and all the other charts we feature on the Bloomberg at GTV Go. This is ETF IQ. I'm Scarlet Fu. This is ETF IQ. Let's get to the ETF life cycle, where we take you through the 3 main stages. And step 1 is the filing. JP Morgan registers a large cap growth ETF that uses the Presidian active non-transparent structure. The fund will use a fundamental bottoms-up approach to pick names in the Russell 1000 Growth Index. Step 2 is the launch. Bank of New York Mellon entering the ETF jungle. It's got a suite of 3 fixed income funds offering core, short duration, and high yield exposures. It's also launching 5 equity ETFs covering small, mid, and large cap U.S. stocks, as well as international developed and EM. And for some, the final stage is liquidation. Invesco, closing its ESG revenue ETF, ticker ESGL, had picked S&P 500 names that met certain ESG criteria and then weighted them by revenue. Time now to get passive aggressive and track the tensions between active and passive investing. When it comes to global markets this year, uncertainty is really the only certainty. When it comes to investment products, we know ETFs continue to build market share. So how do these themes intersect? Brown Brothers Harriman has published its 7th annual ETF survey, and Ryan Sullivan, the firm's Senior VP of Global ETF Services, joins us now to share what the survey found. Great to see you.
Thank you for having me back.
So let's start with ETF adoption, because in the U.S., 72% of those surveyed plan to increase their use of ETFs. Clearly, they're not bothered by the persistent rise of passive products or the potential liquidity issues that certain investors, a lot of hedge fund managers, let's face it, increasingly voice.
I think you might have stolen my thunder here at the top of the show where you said even in this period of heightened volatility, ETF trading is really going off without a hitch. Not to say they're not immune from risks. They're certainly a commingled investment product tracking the broader market. So we will expect to see prices depreciate. We might see spreads widen out in the secondary market. But that secondary market really acts as a liquidity valve for investors when they want to add positions or when they want to get out, as we've seen today in heightened volatility. So that 70% is a great stat. Here we are 30 years into the ETF era, and we still see investors globally saying they plan to increase allocations because of that consistent experience they're having in trading, and also the versatility. ETFs are sort of a Swiss Army knife. You can get fixed income exposure, you can hedge your portfolio, you can get broad beta at very low cost, so very popular with investors.
Okay, and how you decide to split your investments along those lines is dependent a lot of times on model portfolios. This is a global survey that you've conducted, and if there's one thing that investors around the world seem to agree on, it's the value of these model ETF portfolios. Who puts them together and how are they used?
Yeah, it's an interesting dynamic that we really wanted to tap back into this year in our 7th annual survey. So we wanted to go out to the investor population, get a better sense for what they were doing with these models, how they were accessing them. 70% kind of jumped out at us as well. It was one of our more surprising findings. Basically, these are really just alternatives or wrappers to drive an asset allocation model. So increasingly, and we've seen over years, they're hardly new. They've been offered by private banks, they've been offered by large intermediaries and broker dealers as a way to drive asset allocation strategies within sort of a single wrapper. Increasingly, they're built and supported by underlying ETFs in those models. So it's really a good opportunity, one, for ETF issuers, our client base, to identify new distribution trends and potential channels to promote their product, but also design their own models that they may offer to advisors, to other intermediary partners as well. So sort of two trends there happening in the model space.
Why do investors even need advisors then? Can't they do some of it themselves?
Well, they can, and investors can access. If you're self-directed in one of the big brokerage houses here in the States, you can access models offered by that broker dealer, and you can do that independent of an advisor. But what we've also seen is with some of the regulatory burden that advisors are now encountering, their focus is somewhat tilting away in some pockets from asset allocation. So some advisors themselves are starting to use these models. Many design their own, but they can also use third-party tools to further their asset allocation and product offering for their end client.
All right, let's talk transparency, because about 90% surveyed say they want an ETF to disclose their holdings daily or weekly, more frequently than a lot of these active non-transparents are coming onto market, which will likely disclose probably monthly or quarterly, and if they do a daily disclosure, it'll be kind of scrambled. It'll be a proxy. What does this tell you?
Interesting dynamic here. I think, one, it suggests that while these many of these new structures were approved in 2019, we're still waiting for the first ones to come to market. So for me, the big question here is, does the T in ETF really mean transparency, or we're waiting with bated breath to see? I think in these structures, we did ask investors their views on transparency. It showed us that investors have certainly become accustomed to the opportunity to look at the portfolio each day and see those changes day over day over day. Whether or not they actually use it is sort of the question, and these new structures coming in offer additional data sets for investors in lieu of those daily updates. We think, by and large, investors, if they can get the liquidity that we talked about in these products, as well as the products themselves offered at a competitive price, they'll see these as any other ETF in the market.
All right, I got to ask you about ESG as well, because when it comes to what kinds of ETFs people want more of, ESG comes in first in Europe, second in China, but kind of fifth in the US, which I guess matches flows. Why do you think this is? Why is there such a big diversion?
There's a tale of a couple markets here, clearly. I think when you look at Europe and what we're beginning to see take root in Greater China is a little bit more of a top-down focus on kind of standardizing ESG, not only for investors, but for the fund companies themselves offering these products, and more consensus being driven around what equates to ESG, what categories it would fall in. In the US, we sort of have a vacuum right now around that. So it was not necessarily surprising. We saw investors in the US, about 69% say they plan to add ESG at large, not necessarily ETF specific. But to your point, they were ranked number fourth in terms of, or fourth or fifth in terms of where they wanted to see new product. So that's a market we're going to be watching closely to see if that demand or interest equates to flows as we go through 2020.
All right, Ryan Sullivan of Brown Brothers Harriman, thank you so much for joining us today.
Thanks for having me.
Now, coming up, no one will argue that the coronavirus is some kind of black swan event. Next, we show you one ETF that is perfectly built for this type of scenario. And for a drill down into all of our ETF content, you'll want to check out bloomberg.com/markets/ETFs. This is ETF IQ. I'm Scarlet Food. This is ETF IQ. Now, for every ETF focusing on a factor or asset class, you'll find plenty of other funds promising to do the same. What about ETFs that go broader, functioning as self-contained portfolios? Merlin AI has cooked up a pair of funds to do just that, and its founder and CEO Dave Epstein is here with us. Before we talk to him, though, Eric Balchunas is going to give us the drill down into one of the firm's funds, Wiz.
Thank you, Scarlett. Yeah, it's the Merlin.ai Bull Rider Bear Fighter ETF. And I can best explain it by just going over its name. It uses AI to try to ride bull markets and fight bear markets, right? So it's either going to be sort of, it's momentum strategy. It's going to use other ETFs, different sectors, countries to try to ride momentum, both sides, whether it's bullish or bearish. It's a new fund, but 50 million still is pretty good for the age that it is. 60 basis points about average for this kind of active strategy. Let's look at the holdings. So again, it's going to hold other ETFs. And what you're going to see here is a very growthy, so right now it's riding the bull market, right? It only rebalances monthly, so even though we've had a couple nasty days, this is still in effect, right? Let's look at the performance of this versus, I picked FVC, it's the First Trust Sector Rotation ETF. There's not a perfect benchmark. And the S&P 500, you can see this kind of saved you a little bit here. This is an ETF, because you're diversified, isn't going to quite get you the same pop of the S&P. It might save a little of the downturn. So, Scarlett, I think this is one that's got a really clever name, and performance will really be what draws investors.
It's always performance. All right, still with us is Dave Epstein of Merlin AI. Dave, this is a fund that can shift between different modes, conservative, growth, something in between, and you're relying on AI to make the switch. But I notice it's also monthly rebalancing. So what if you've missed some of the run or a lot of the run? Can humans override the AI?
This is the point of Merlin itself. So the technology really is based on understanding where the market's going over time. So that's the momentum idea. And this always is looking at a number of factors underneath that sets up for whether you're going into a bull or a bear market. But we don't specifically act quickly on anything, because you don't want to get whipsawed, and this happens all the time. When you get some sort of outbreak of something, all of a sudden you get a sharp drop, but the next day it can come right back up again, and that's what we don't want to do. So we look at the end of the month when the professional traders are trading, and we get that fundamental understanding, and that's where the signal comes in. That
okay, so no human intervention then?
There's no human intervention in this.
Speaking of non-humans, AI, right? It's a word we've been seeing more and more in the ETF world. You break AI down, and you're from Palo Alto, so I feel like this is going to be next level right now. Genetic algorithms, fuzzy logic, and adaptive tuning. So could you try to simplify that for somebody who doesn't really know what that is?
My rice cooker used fuzzy logic, by the way.
Sure. Yeah, AI is the basis for what we're doing, and yes, I'm in Silicon Valley, the heart of it, and I'm studying AI all the time and seeing all different kinds of things. So AI is really promising, and it really is the future of a lot of different things. But for markets, you have to be very careful about using AI because there are so many different factors and variables that go into it that if you just applied basic learning, which is what AI does, then you're going to be creating a lot of noise. You're going to be based on a lot of noise. That's how it's going to come to decision. Instead, by breaking it into this adaptive tuning, which is looking and adapting to the changes in the marketplace, and the genetic algorithm, which is actually evolving over time. So just like genetics in our bodies, there's mutations, and then the survival of the fittest moves on to the next level. And then those also create offspring, and then those are regenerated, and again, it moves forward. So this is using AI in the way that is actually allowing it to evolve without knowing what actually is going to happen, and comes to a better decision.
Was that next level enough for you?
Yeah, I feel like this is what's discussed in Palo Alto Starbucks.
Well, I mean, we
Yes,
talked about Palo
MP.
Alto, and of course, that's home of tech startups and such. Are you disrupting advisors with this fund?
We think that this is actually helping advisors quite a bit because what this does is it allows in one self-contained wrapper, an ETF wrapper, this allows the advisor to put some of the money into either Wiz or Snug, and these allow over time for it to trade all underneath the ETF wrapper, and they can spend, it's all automated and changing and such, and then they can spend their time doing more important things like getting more clients, like working on other things. So actually, I think this is a better way of being able to allocate their investment strategies for each individual investor and makes them more productive.
And just to be clear, Wiz a little more aggressive, or can be bearish too, though, but Snug is more conservative.
Yeah, they both work on the fact, so Snug is a 30-70, 30% in equities and 70%, and Wiz is an 80-20 fund. And I noticed you put up the performance there, and you'll see that that one is very much closer to an 80-20 kind of thing. But both of them, in a bear market, switches to nearly 100% defensive.
All right, got it. Dave Epstein of Merlin AI, based in Palo Alto, here in New York for the day. Thank you so much.
Thank you.
Now, right now, investors are dealing with the known unknown of the coronavirus. This week, there's an ETF for that, highlights another risk, the unknown unknown, to quote Donald Rumsfeld.
The amplified Black Swan Growth and Treasury Core ETF trades under the ticker SWAN. Its goal? Protect investors from so-called black swan events, situations where something deviates beyond what is normally expected. These events are extremely difficult to predict. SWAN seeks uncapped exposure to the S&P 500 while shielding against the possibility of significant losses. SWAN does this by investing 85% of its assets in treasuries and 15% in long-dated, in-the-money call options, known as LEAP options, on the SPDR S&P 500 ETF. The treasuries in the fund's holdings provide a mix of maturities, aiming to reflect around 10 years on average. SWAN made its debut in November 2018 and is ahead of the S&P 500 over that time. The fund rebalances twice a year, has some $190 million in assets, and an expense ratio of 49 basis points. SWAN gets a green light in the Bloomberg Intelligence traffic light system with no warnings.
I feel like the coronavirus is a gray swan that kind of just swims around. It doesn't really leave. It doesn't really make a comeback. It's just hanging out in the background.
Yeah, I'm interested to see. This is a really interesting new risk. And then we've got Trump on the Fed on the other side. Who will win this battle? We'll see.
All right, that does it for Bloomberg ETF IQ. Be sure to catch us each Wednesday at 1 p.m. New York time, 6 p.m. in London. This is Bloomberg.